Hey, it's Maria, and today I want to talk about getting started with investing. So, this channel is about generating wealth, creating wealth, getting to a place of financial freedom from where you are today. And that means passive income in part. It could mean other things too, but a big part of it is creating and generating enough passive income so that you never have to work again actively if you don't want to. And in order to get there, we have to get started. And a lot of people really get hung up on that because there's so many opportunities out there, so many scams out there, so many ways that you get big promises and few results. And so I wanted to share with you something that I'm doing that is going to help you get started with investing, even if you've never really invested before. I mean, we talked in a previous video about 401ks and IRAs and bank accounts being investments, but this would be a decision that you make consciously to start investing. So let's get started. Did you know there's an investment out there that pays way more interest than your savings account? It's stable, it protects your investment, it has a very low minimum purchase, it's easy to understand, and it's safe and backed by the government. Like, is there such a thing? Yes, there is, and you may already know about it and you may already be invested in it. But if you're not, then this will be news to you and it's something that you may want to consider for yourself. Okay, before we get started, I just need to tell you I am not a financial advisor. I am not a guru by any means. I'm not out there saying, oh, buy this and buy that and getting this biz op and getting that biz op. No way. I'm an ordinary person. I'm investing in stuff myself. If I'm doing it and I like it, I'll share it with you. If I'm not doing it, I'm not going to share it with you. So you'll never get a recommendation from me that I'm not doing. Also, you have to remember that investing is risky. You can lose money. People lose money all the time. People have lost tons of money in the stock market in just the last couple weeks because it took such a dive, and the same with crypto. So you can lose money in investing. So only use funds that you don't need. Money that you are not going to need. You don't need it to pay the mortgage or the rent. You don't need it to have an emergency fund. It's extra money. All right, so what am I talking about here? What kind of investment would do all the things that we looked at before? All of these things. Well, the investment is, ready for it? Bonds. I bonds. So, what the heck are bonds? Well, if you go to the bank and you borrow money, then the bank is the lender and you are the debtor. You have to pay them back plus interest. Bonds are the opposite. You go not to a bank, but to the government, and you loan them money and they have to pay you interest. You could also do it for companies, but we're talking about government bonds here. So, what are the types of bonds? Well, there are treasury bonds, which are from the US Treasury. There are savings bonds, which is what I'm going to be talking about today. There are corporate bonds, which are issued by companies, so you would be loaning a company money. And if you've ever heard of junk bonds, those are high risk corporate bonds. So that company may go belly up and you may lose your money. Probably not going to happen with the government though. And then there are municipal bonds, which are issued by cities instead of the federal government. So, what specifically are I bonds? Those are savings bonds, like I just said. They're issued by the federal government and they are going to pay you interest. And why are we focusing on them? Because right now they have a really good interest rate, and because they're safe, your principal, the amount you invest, is going to be safe. You're going to earn interest. Every 6 months you're going to get interest compounded. The US government is a pretty safe bet. If the US government goes belly up and doesn't pay your bonds, and we have way bigger problems than just whatever money we put into bonds, right? So overall, I feel like it's a good deal. It was a good enough deal for me to buy some, and that's why I'm sharing it with you. So who can buy them? All right, first you have to have a social security number. You have to be a U.S. citizen or a resident or a civilian employee of the U.S. So if you are a resident, a citizen of, say, France, but you're working for the U.S. government in the U.S., you can get these I-bonds, and probably they would issue you a social security number in that event. All right, you have to be over 18. You can buy them for a child using what's called a custodial account, but you as an adult have to have the main account. Also, a trust, estate, corporation, partnership, and some other like business entities or like non-person entities can buy these, but I'm not really going to get into that because if you're just looking to make your first investment, you're probably not quite there yet. Okay, types of I-bonds. They're electronic, the ones that you buy online. That's what we're mostly going to be talking about today. And there are paper ones where you'd actually get a paper bond in the mail. So here are the criteria. $25 to $10,000 in 1 cent increments. You buy them online for the electronic ones. The paper ones you can buy from $50 to $5,000, and here are the amounts: $50, $100, $200, $500, $1,000, but you can only buy them with your tax refund, so you can't send money in. It has to come out of your tax refund. And since most of us have already filed taxes for 2021, it really wouldn't apply until next year for most of us, so I'm not going to really talk much about them. All right, what are the limitations? The limitations are this. The max purchase that you can do in a calendar year is $10,000 for an electronic bond or $5,000 for the paper bond per individual. You could do both, so you could get to a total of $15,000. Redemption. You cannot redeem them in the first 12 months. So if you buy a $100 bond, you can't cash it in for 12 months. And there's a small interest penalty if you redeem them in the first 5 years. So those are the limitations. The term is 30 years, which isn't really a limitation. It's just when they mature, but you could cash it in earlier. Okay, calculating interest. Interest is figured monthly. So every month you're going to have interest figured on your amount that you've invested, but it's compounded semi-annually, and I'll get into that in a minute so you understand it. It's made up of a fixed rate and an inflation rate. And the current combined interest rate is 9.62%. That's per year. So for 6 months, you would make half of that. So before May, they reset the interest rate in May and November. So before May, the interest rate was 7.12%, so it went up quite a bit. Now that's a mixed bag because, as you can see by the last bullet point, the interest rate is tied to inflation and can go up or down even to 0%. Well, inflation is really high right now, which is why the interest rate is really high right now. So it's good for us buying bonds because we're getting higher interest. It sucks for the rest of our lives because it means everything else is higher too. So my thinking is, it's partly government policy that's causing everything to be so high. And so I want to get a little bit back from them, I figure they kind of owe me for all of the stress they're causing me in my life. So if I can get 9.62% annually from them, hey, I'm on board. Okay, on to the next one. The combined interest rate. We're going to talk about what that means. The fixed rate never changes, and they publish this again in May and November. Right now it's 0%, and it's been 0% a lot of times over the years, and sometimes it's 0.5% or 0.2% or 1%. At the very beginning, in the late 1990s, when I-bonds first came out, the fixed rates were like 3%, but then inflation was really low. But it hasn't been that way in a while. It's been 0 or just a little over 0. The inflation rate is calculated at 2 times the semi-annual inflation rate. So currently the government has published that the semi-annual inflation rate is 4.1%, times 2 is 9.62%. It's adjusted in May and November each year, the first business day of those months. So if May 1st is a Sunday, it's going to go into effect on Monday. But when I looked at the history of it, it looks like it's always on the first of each month, May and November. Interest is earned every month and compounded semi-annually. and you receive the current interest rate for 6 months from the day you purchase the bond, and then it renews at the current rate for the next 6 months. So let's get into this a little bit so it makes more sense. So here's an example. On July 15th, 2022, you buy a $1,000 bond. $1,000 is a nice round number. You earn interest from the first day of the month you bought it, so you're going to get interest from July 1st. So in theory, you could buy it on July 31st and get interest for all of July. And then interest is compounded semi-annually every 6 months. And right now it's 9.62 per year, or 0.8017% monthly. Now, if you think about your savings account at your bank, my savings account pays 0.01% per year. 0.01%. So on $1,000, I'd get like $1. Woohoo, I'm financially free. I got $1. That won't even buy you a candy bar anymore or a soda. So, and even the high interest rate ones, like I'm seeing high yield savings accounts, 0.7%. So you're getting per month on your money more than you would get in a year from these so-called high yield savings accounts right now. That's another reason I thought I got to buy some of these. Okay, let's go on with our example. So for your $1,000 bond times 0.8017% interest per month, you would get $8.02 a month, but I went ahead to 3 decimals. So for the month of July, August, September, October, November, December, you would get that amount times 6, $48.10. That's a whole lot more than the dollar you would get for the whole year on your $1,000 in the bank. Or if you have a high yield account at 0.7%, you would get, wait for it, $7 for the year. So wow, so you're already ahead just in the first 6 months. So then after 6 months, interest is compounded, which means it's added to your balance. And now you have $1,048.10. So then it starts over again. But now we're going to use the rate that was calculated, the rate that they set in November. Okay? So we're going to pretend that in November there was a new rate of 10.54%, which means inflation went up again, which means our lives are even more stressful. But we're going to use this for the example. So now, 10.54 divided by 12 months gives you a monthly rate of 0.8783, which is going to give you $9.20.5 per month. So for the next 6 months, January, February, March, April, May, June, you're going to get that 9.205 times 6, or $55.23. Now remember, that is interest on your $1,048.10, so your $48.10 interest is now earning interest. You're getting interest on your interest. That's what compounding is all about. So then at the end of that 6 months, interest is compounded, add it to your balance again, and you have $1103.11. And then it will use the rate that was set next May and do it for another 6 months over and over until the 30 years is up. It matures in 30 years, or until you cash out. Let's do another example, this time based on the interest rate going down. So same numbers at the top. You get for your first 6 months $48.10, but in November inflation went down, yay for us, and now your rate is 8.14%. And these numbers are made up, by the way. I don't know what the rates are going to be. I'm just using them for an example. So 8.14 equals 0.6783 per month equals $7.11 per month, basically. So for the next 6 months, you're going to get $7.11 times 6, 7.109 actually, so $42.66. So that would be added to your $1,048.10. You're still getting interest on your interest, just not as much. And now you have $1,090.76, and it just keeps repeating again until you cash out or until it matures. I hope that makes sense. If not, watch this part again. So how long can it go? Or how low can it go? Sorry. Well, the inflation rate can go to 0 or even below. You could be in a period of deflation, and if you look at the historical chart on the government website, for bonds, you're going to find that there were times that there were negative inflation. So the inflationary rate actually can go below zero. However, there is a safeguard in there, so the rate on these bonds will never go below zero. So if the deflationary rate is like 3%, we're losing inflation at 3%, so it's a negative 3%, you're still going to be at 0%. So you won't make any money, but you won't lose any money. You're never going to lose the amount that you initially put in, and you're never going to lose the interest once it's earned and compounded. So that's important to know. That means that it's a safe investment. You're never going to lose your principal, unlike the stock market where you could invest $1,000 and it could be worth $700 the next day or less if you have a crash. So if it can go to zero, is it worth it? I kind of already talked about that, but let's get in more detail. First of all, it's unlikely that it's going to go to zero in the next year. If we went from a 9.62 rate down to zero, that would mean a major crash in inflation, which would mean major changes in our economy and our country, and things just don't move that fast. I mean, it did go up 2 points from from last November to May, and it could go down 2 points, and it could even go down 5 points, but I doubt it's going to zero. Like, that would be very weird. Also, keep in mind that savings accounts right now are paying less than 1%, so anything over that is a win. That was important to me. So even a high yield account at 0.7% interest, which is what I'm seeing advertised today, is $7 on your $1,000 investment. So still not very good, and you're getting more than that per month on this. So also, if the economy changes significantly, like majorly, and you just decide this is totally not a good investment, you're only stuck with it for 12 months, and then you can cash out. Now, there is a small fee, a small interest penalty that you're going to have to pay, but you're never going to lose your principal. So what is the interest penalty? All right, I already said you can't cash in before 12 months. And from 12 to 60 months, that's 5 years, there's a 3-month interest penalty if you cash in. And after 60 months, there's no penalty. You get all the interest. So let's say you cash out at 24 months. So you get 21 months of interest. If the rates have dropped to zero or so low that you think it's not worth it anymore, it's not going to be a huge loss in real dollars. And if the rate drops to zero, you could just keep it for another 3 months and then cash out. So you're effectively going to have a zero interest penalty because it's the last 3 months that you lose, not the first 3 months. Okay, what about the 30-year maturity? That means the bond stops earning after 30 years. So you can cash it in at any time except the first 12 months. You can cash it in at any time after that, just with that 3-month interest penalty if it's before 5 years. But if you forget about it, and then like in 40 years you're looking through an old notebook and you're like, oh yeah, I had these bonds. Is it still good? Yes, it's still good. You can still cash it in, but after 30 years, it's just not earning any interest. So you're going to see interest up to year 30, and in years 30 to whenever you cash it in, it's just going to be zero. It's just going to sit there. So it pays to pay attention to your bonds and also let other people know about them because they can become part of your estate. And there's actually a section on the website, what happens if the bondholder dies. All right, paying the tax man. Yes, you do have to pay taxes on the interest only. So remember that example where you put in $1,000 and you made $48.10 for the first 6 months. Well, let's say you could cash it in after 6 months and you decide to cash it in. You only owe tax on the $48.10, not on the $1,000 because that was what you put into it. You know, you would never pay tax on what you put into your savings account, only on the interest. So the same holds here. And the other thing about this is you have to pay federal tax, but not state or local tax. So if you live in a state or in a city that has local or state tax, you are not going to get taxed on this interest. So that's kind of nice. And again, you pay tax only on the interest when you cash out, not the initial investment. All right, buying strategy. So I thought about this. I thought, if I had $10,000, would I buy a $10,000 bond? Or would it be better to buy $1,000 a month or $1,000 times 10 all at once? What would it be better to do? And what I decided for me is that I think it's better to buy smaller amounts. Yes, you're going to have more of them, but there's a summary and when you log into your Treasury Direct account, so you're going to be able to see what you own and when you bought it. But the reason I decided that smaller amounts would be better is, what if I need the money? What if I have a disaster and I buy a $10,000 bond and I need $1,000? Well, if you have a $10,000 bond, your only option is to cash it out, pay the interest on all the $10,000, and then you can buy more bonds later. But if you have 10 $1,000 bonds or 20 $500 bonds or 100 $100 bonds, then you can just cash out the ones that you need and only pay interest on the ones that you cashed out. You still have all the rest of them that are still growing, tax deferred, because you don't pay tax until you cash out, and you're not blowing your whole investment, I guess would be the way to say it. So I decided to buy $100 bonds instead of larger amounts. And I also decided to space it out because I don't have a huge savings account like a lot of people. So every time I get paid, I have a budget to buy X number of dollars in bonds. And remember, you don't have to buy anything except $25. That's the minimum. So you buy $25, $25.01, $25.02, $50, $76.83, $100, $500, whatever you can afford and want to buy, as long as it's over $25 and you don't cap out on your $10,000 for the year. So that's the way that I decided to do it, to buy them in $100 increments and to space them out as I could afford them. Okay, more information. So the website is treasurydirect.gov. And that's the actual government website. You want to make sure it says GOV at the end. That's the government website, not any fake website, not any scammy website. And I'm going to click on this and go there so I can show it to you. So as you can see, it says right at the top, did you know you can purchase I-bonds at the current rate through October of 2022? And then you can click to learn more. But what we're going to do is we're going to go right down here and we're going to look right here, up-to-date I-bond information. There's some right here, but it's the same information, like how to buy I-bonds, same how to buy I-bonds. So you're going to go to the same pages. So let's open all of these in a new tab. I'm not going to go over it in detail because I already told you the important stuff that it says. And before we go there, here's how you get started. You open an account, and then to log in, you go to treasurydirect.com. Now, when I opened an account, it asked for my social security number, my basic address, name, all that kind of stuff. And it also asked for my driver's license number. So if you don't have a driver's license, I don't know if it takes different kinds of ID, like a state ID, because I just put in the information and I just set up an account. All right, so buying Series I savings bond, here is the rate, just like I told you. And I want you to read through all of this. I'm not going to read through all of it, but I want you to really read it, click the links, research it as if you are going to be investing $1 million. And the reason that I say that is because this is a really good opportunity to learn how to do research before investing money. You can also Google I-bonds and find out what people are saying about them. I know Suze Orman, I can't say her name right and I don't really follow her, but I did see an article that said that she's been endorsing I-bonds for years and she's been encouraging people to buy them. So that is a really big kind of financial guru who has been recommending them. So I would search Google, or another search engine and find out what other investment people are saying about them. Remember, I'm not a professional. I'm only telling you what I'm doing and why I think it's a good idea, and you have to make your own decision. And really reading through will, in looking at the questions and seeing what they say, will be a good education and practice in starting to research for when you get into other investments later. And this is a really well thought out website. They have tons of information, tons of questions and answers, and you should find all of them there. And if you don't, or if something doesn't make sense, then leave a comment on this video and I will try my best to point you in the right direction or see if I can get an answer for you. So this is just more general information about them. It's kind of the same information as on the other page. And look, there's all sorts of different things that you can click on down here to find even more pages and information. This is calculating interest rates. We already went over that, but this is giving you a lot more information on how to do it. Past rates, fixed rates, and inflationary rates. You can see right here it had a negative in 2009. It was a negative inflation year. In 2015 it was a negative inflation year. And it looks like those are the only two that I see, but it can be negative, but you'd still get 0%. That's not much, but you'd still get it. And you can also see that these rates were pretty low for most of these years, and it's just been in the last year really that we've had this high inflation, which is what put this on my radar, because I knew about them, but I didn't really care about them before that. And that's another thing I wanted to say. Is this like the end all be all investment that you should be in forever? No. I'm saying that right now, with the rate that it's at now, it's a good investment for me for today. Now, I'm going to reevaluate in that in a year and see if I still think it's a good investment. And I'm going to do that in 2 years and still see if it's a good investment for me. So you never think of anything as forever, because it's not. But if you said, well, a couple years ago, it really wasn't that great of an interest rate, so it's going to go back down, so I'm just not going to do it. Well, then you could be missing out on a year or two of really good interest. And, that's the kind of thinking that keeps people from ever investing at all, because it's good now, but it's not going to last. And we don't want that. So you need to jump on things when they're a good investment and then reevaluate and decide if and when it's time to move on to something else. That's why I like that you can cash in after 12 months. So, even if the interest rate went to 0 in the next 6 months, worst case scenario, you would still have your first 6 months guaranteed at 9.62%. So you'd still make $48.10. And even if you made nothing the next 6 months, that's still way above the $1 that you would have made in your savings account, or the $7 you would have made in your high yield savings account for that same $1,000. So that's another reason that I just thought, wow, I need to be in on this. It's like a no-brainer. Then finally, we talk about FAQs, and I want you just to read through all of these. If you click on these, they're just down below, but you can click on these and jump down to the section and look at all the other information on the website, because again, this should be as well as a possible first-time investment for you, or additional investment if you haven't looked at these in a while or didn't know about them. It's also a great opportunity to learn. I can't stress that enough. Really use it as an education and researching. Okay, that is it for now. Again, open an account here, log into your account here, check out the entire website, go back through this video if you have questions. If you still have questions, put them in the comments below, and I will do my best to get you the right answers. If you have I-bonds already, then let me know below and let me know why you decided to buy them and if you still think they're a good deal. And if you don't think they're a good deal, then tell me that too, because the more that we communicate and the more that we comment, the more we learn, the better we're all going to do. We're all going to become better investors and move towards that passive income. And that's really what I want this to be about, is community and helping each other out. So again, that is it for now. I just got paid yesterday, so I'm going to go and buy another bond today. Peace out, and here's to our success.